If you spot these signs in yourself, your trading will never be the same again. Most traders work hard, follow signals, and watch charts endlessly. But the real edge isn't in what you do, it's in how your mind works under pressure. In this video, we uncover the hidden traits, mental shifts, and fearless habits that separate consistent winners from everyone else. Watch closely, because recognizing these signs in yourself could instantly unlock the mindset that turns ordinary traders into unstoppable market dominators. The first sign of a winning trader begins long before consistent profits appear. It begins in a place where most people don't look: your mindset, specifically the way you respond to uncertainty, discomfort, and delayed gratification. Every trader starts the game emotionally charged, excited by the possibility of big wins, scared of losing money, rushed by impatience, and constantly searching for shortcuts. But as you mature, something deep inside begins to shift. You begin to detach from impulsive behavior. You begin to see the market not as a place to get rich quickly, but as a long-term environment that rewards discipline and emotional control. In early stages, traders jump from strategy to strategy. They watch many YouTube videos. They look for magic indicators. They hope someone will tell them what to do. A winning trader, however, starts developing internal decision-making. That's the first big sign you stop outsourcing your thinking and start trusting your growing skill set. You begin to understand why a setup works, not just that it works. You start journaling, not because someone told you to, but because you genuinely want to understand your behavior and refine your edge. Another major shift that marks the birth of a winning trader is the moment you stop comparing yourself to others. In the beginning, most traders feel jealousy or frustration seeing others win. They wonder why they aren't improving fast enough. But eventually, a winning trader detaches from external benchmarks. You no longer care if someone made $2,000 today and you made $20. You no longer feel pressured to catch up. Instead, you narrow your focus to your own consistency, your own progress, and your own improvement curve. You understand that mastery takes time and that the only competition is who you were yesterday. Then comes a deeper transformation, an obsession with process over outcome. Early traders are obsessed with the results of one trade. They celebrate wins emotionally and panic during losses. But a winning trader sees a much bigger picture. Every single trade is just one sample in a long series. A loss is nothing but data. A win is nothing but confirmation that your system is working. You stop feeling the emotional roller coaster because your identity is no longer tied to individual outcomes. At this stage, risk management finally becomes something you take seriously. In the early phase, traders know risk management is important, but they ignore it. A winning trader, however, truly understands that improper risk will destroy them even if their strategy is good. You start risking less, trading less, focusing more. You stop swinging for home runs. You become strategic. You accept that not losing is more important than winning big. You finally internalize the truth that longevity beats aggression, and then, slowly but surely, your relationship with losses transforms. This is one of the biggest and most surprising signs of a winning trader. You stop being afraid of losing. Losses don't scare you anymore because you know they are part of the game. You embrace them. You study them. You use them to refine your edge. Losing no longer disrupts your emotional state. Instead, it fuels your understanding. You also begin to see the market differently, not as randomness, not as chaos, not as an enemy, but as an environment you must adapt to. You begin to recognize patterns and behaviors that most ignore. You begin to understand timing, momentum shifts, accumulation, manipulation, and liquidity. You stop fighting the market and start letting it tell you what phase it is in. You adjust, you adapt, you grow. Finally, you develop patience, the rarest commodity in the trading world. You start waiting for only the highest quality setups. You skip low probability trades without feeling FOMO. You enter late rather than early if confirmation is needed. You hold winners longer because you trust your read. You cut losers quickly because your ego is no longer attached to being right. This is the beginning of becoming a winning trader, not profit. Not a big trading account, not fancy tools, but this transformation, this quiet psychological shift, and every winning trader in the world has gone through it. Emotional mastery is the silent foundation of every winning trader, and the moment you begin developing it, your entire trading world starts to transform in ways you never expected. In the early stages of trading, emotions control everything. Fear pushes you out of good trades, greed pulls you into bad ones, FOMO forces you into impulsive entries, and frustration triggers revenge trading that destroys your account. But as you evolve, you begin to step into a different psychological space, one where your emotions no longer dictate your decisions and your reactions become measured, intentional, and calm. This shift does not happen quickly. It begins with small moments where you notice yourself staying composed in situations that once triggered chaos. Maybe a trade goes slightly against you, and instead of panicking, you breathe. Maybe you miss a setup, and instead of chasing it, you accept it. Maybe you take a loss, and instead of spiraling emotionally, you analyze it. These small signs are the earliest indicators that emotional mastery is forming. A winning trader understands that emotions themselves are not the enemy, it's the lack of control over them. Emotional mastery does not mean you never feel fear or greed. It means those emotions no longer influence your execution. You feel the emotion, acknowledge it, and act according to your plan, not your impulses. One of the clearest signs of emotional mastery is the ability to pause before reacting. Early traders operate in pure reaction mode. They see a candle move and jump in, see a wick and jump out, see a loss and double down to fix it. But a winning trader develops space between stimulus and response. You pause before entering, you pause before exiting, you pause before adding risk. This tiny pause is one of the greatest superpowers in trading because it prevents emotional decisions from slipping into your execution. Another sign is emotional neutrality toward money. Most traders obsess over dollar amounts, how much they made, how much they lost, how much they need to recover. But as you move toward becoming a winning trader, money becomes secondary. You stop seeing trades in terms of dollars and start seeing them in terms of R, multiples, probabilities, and execution quality. This shift detaches your emotions from your results. A 100 loss feels the same as a 1,000 loss in terms of emotional impact because both are simply one-hour outcomes. This is emotional maturity. You also begin developing emotional resilience, the ability to withstand losing streaks without mentally collapsing. Early traders fall apart after a few losses, questioning their strategy, their skill, and even their worth. But a winning trader understands variance. Losing streaks don't shake you anymore. You don't rewrite your system out of fear. You don't panic. You don't react impulsively. Instead, you investigate, was it market conditions, execution mistakes, or normal statistical variance? This analytical response is a major sign that you're evolving. One of the most powerful indicators of emotional mastery is the disappearance of overreaction. Wins don't make you euphoric, and losses don't make you depressed. You remain centered. Emotional neutrality is the highest form of trading maturity because it prevents both overconfidence and emotional destruction. Winning traders know that both winning streaks and losing streaks are temporary, so they never allow emotions to swing too high or too low. Another sign is improved self-talk. Early traders speak to themselves harshly after mistakes, calling themselves stupid or hopeless. But as you develop emotional mastery, you switch to analytical self-talk. You ask questions: what triggered this decision? What fear was I reacting to? What can I adjust next time? This type of self-dialogue makes you more self-aware and helps refine your decision-making. Emotional mastery also shows itself in boredom tolerance. Early traders need constant action. They crave movement and trades. But a winning trader becomes comfortable with waiting. Boredom no longer feels like a threat. You understand that most of your job is waiting for high-quality setups. You accept that silence is part of the game. This patience is a powerful emotional skill. Another subtle sign is the ability to walk away. Instead of forcing trades when the market is slow, when you're tired, or when you're emotionally off balance, you simply stop. You close the charts. You protect your mental capital. Early traders feel guilty when they don't trade, but winning traders feel proud that they avoided low-quality opportunities. Emotional mastery also leads to emotional independence. You stop being influenced by other traders, stop chasing signals, stop copying entries online, and stop seeking external validation. You trust yourself. You base your decisions on your plan, not on what someone else posted. Your confidence becomes internal rather than borrowed. And perhaps the strongest sign of emotional mastery is the smoothness of your execution. You enter calmly. You exit calmly. You manage risk calmly. You follow rules calmly. You let trades play out without interfering emotionally. You operate like a machine, not emotionless, but emotionally controlled. When you reach this point, you are no longer a beginner. You are no longer battling your impulses every day. You are stepping into the mindset of a professional. Emotional mastery doesn't just improve your trading, it transforms it. It becomes the invisible shield that protects your consistency and the silent engine driving your growth toward becoming a winning trader. Most traders believe strategy is everything, but strategy alone has never created a consistently profitable trader. What truly separates the winners from everyone else is the way they think, the strategic mindset that rewrites their entire relationship with the market. In the beginning, traders think emotionally, randomly, and reactively. They want quick wins. They want shortcuts. They want certainty in an uncertain environment. But winning traders think differently. Their minds operate on principles, logic, structure, and long-term probability. This shift in mental operating system is one of the biggest signs that you are becoming a winning trader. The first aspect of the strategic mind is the transition from prediction to preparation. Early traders want to guess where the market will go. They obsess over trying to know the future. They draw arrows on charts hoping price will follow. But winning traders stop predicting and start preparing. Instead of asking, "What will happen?" they ask, "What could happen? And what will I do if it happens?" This mindset transforms trading from emotional gambling into professional execution. You no longer marry a bias. You no longer force a direction. You create a game plan with multiple scenarios and remain adaptable. You stop arguing with the market and start flowing with it. That adaptability is one of the clearest signs of a strategic mind. You begin seeing the market not as bullish or bearish, but as a sequence of evolving conditions, trending, ranging, consolidating, accumulating, distributing, trapping, sweeping liquidity, and manipulating. You start understanding that your job is not to impose your logic on the market, but to align yourself with its behavior. This awareness leads to the second major trait of a strategic thinker. You begin valuing context more than signals. Early traders look for signals, indicator alerts, candlestick patterns, breakouts, crosses, thinking these alone create an edge. But winning traders study context, where the signal appears, why it appears, who benefits from that move, and what phase the market is in. The same pattern in two different contexts has completely different probabilities. A winning trader understands this deeply. They analyze structure, liquidity, volatility, and timing before ever considering an entry. They know that context determines the outcome. This is why winning traders wait patiently for confluence, while beginners chase every shiny candle. A strategic mind also sees the market through the lens of asymmetry, seeking situations where the potential reward greatly outweighs the risk. You begin rejecting any setup that offers low IRR, even if it looks technically clean. You focus on stacking odds, direction, liquidity, timing, structure, momentum. Every trade becomes a calculated decision rather than a hope-driven one. Another sign that your mind is evolving is the way you interpret losses. Early traders see losses as personal failures. They see them as proof that they are bad traders. But a strategic trader sees losses as data, information, probabilities playing out, and expected outcomes. A strategic mind understands that even a high probability setup loses sometimes. This awareness stops you from overreacting to individual trades. You no longer adjust your entire system after one bad day. You no longer panic when a winning setup fails. You remain grounded in the long-term expectancy of your approach. This is a major breakthrough. Another powerful element of the strategic mind is the ability to separate a good trade from a winning trade. Beginners think a good trade is one that makes money. Winning traders know a good trade is one that was executed according to the plan, regardless of outcome. A bad trade is any trade taken emotionally, impulsively, or outside your rules, even if it results in profit. This distinction is one of the most important signs of a maturing trader. When you begin rating trades based on process instead of result, you're thinking like a pro. Another clear indicator of the strategic mind is your evolving relationship with time. Early traders think short-term. They want to make money today, this week, or this month. They want instant results. Winning traders think long-term. They operate in months and years. They understand that edge is proven through hundreds of trades, not 5 or 10. They don't panic during drawdowns because they understand long-term performance metrics, win rate, expectancy, risk of ruin, and average R multiple. They trust the math, not their emotions. A strategic trader also understands phase behavior, knowing when to be aggressive, when to be conservative, and when to stand aside. Early traders apply the same intensity every day. They trade often because they feel they must. But a winning trader picks battles intelligently. They reduce size in uncertainty. They increase size when their system aligns with market conditions. They avoid trading during choppy sessions. They know when not to trade, which is one of the highest forms of skill. The strategic mind also operates on simplicity. Early traders clutter charts with indicators and tools, thinking more information leads to more accuracy. Winning traders simplify. They strip charts down. They track only essential metrics. They rely on clarity, not complexity. Simplicity improves speed, accuracy, and calmness, critical for decision-making. Another major sign that your strategic mind is developing is the way you handle uncertainty. Early traders crave certainty. They want trades that won't lose. They want strategies that always work. But winning traders embrace uncertainty. They know every trade is uncertain. They know the market owes them nothing. They know even the best setups can fail. They thrive in uncertainty because they rely on their edge, not guarantees. They accept randomness without emotional resistance. This psychological acceptance is foundational for advanced trading. Another trait that emerges is probabilistic thinking. Instead of asking, "Will this trade win?" you ask, "Does this trade have a positive expected value?" You begin thinking in distributions, patterns over large sample sizes, and long-term outcomes. You stop obsessing over the result of a single trade because you know a single trade means nothing in isolation. This is the thinking style of casinos, hedge funds, and algorithmic systems, and the thinking style of a winning trader. One more sign is the emergence of patience in analysis. You spend more time preparing than trading. You mark key levels, identify liquidity zones, study timing, track volatility cycles, and build a narrative before the market even opens. You no longer rush. You allow setups to come to you. This is how professionals operate. Another sign of strategic evolution is your willingness to be wrong. Early traders hate being wrong. They hold losers because they refuse to accept failure. They add to losing trades out of ego. But a winning trader accepts being wrong immediately. They cut losses without hesitation. They understand that being wrong quickly is far more profitable than being right eventually. This is humility in action, and humility is the backbone of strategic thinking. Finally, the strategic mind is defined by consistency. Your behavior becomes stable, your rules are followed, your process becomes repeatable, your execution becomes robotic. You remove variance caused by emotions and impulsiveness. You operate like a system, not a gambler. This strategic evolution is the heart of true trading mastery. When your mind shifts from emotional, random thinking to structured, probabilistic, strategic thinking, you are no longer just participating in the market. You are understanding it, navigating it, and exploiting it. And this transformation marks the beginning of becoming a truly winning trader. Risk control is the backbone of every winning trader's career, yet it is the one element most traders ignore until it's too late. Strategy can fail, emotions can wobble, the market can shift, but strong risk control is what keeps a trader alive long enough to evolve into a professional. When you finally begin to understand risk not as a protective measure, but as the engine of long-term consistency, it becomes the clearest sign that you are stepping into the ranks of winning traders. In the early stages, traders behave recklessly. They jump into positions without thinking about risk to reward. They risk too much on random trades. They size up impulsively. They add to losers hoping for miracles. They hold losses far longer than they should. Their decisions are driven by fear, hope, greed, and pressure. But winning traders think differently. Their entire existence revolves around protecting capital, controlling downside, and ensuring survival. They know that as long as they stay in the game, they will eventually capitalize on their edge. This understanding transforms the very structure of their trading. The first major sign of a mature trader's risk mindset is their ability to define risk before entering a trade. Beginners enter first and think later. Winning traders think first and enter later. They determine their stop loss, position size, risk amount, and exit conditions before clicking the button. Everything is predetermined. Nothing is left to emotion. This clarity allows them to trade with confidence because they already know their worst-case scenario. Another crucial sign is the shift toward risking small. Early traders want big wins. They think risking more will speed up their journey, but this mindset destroys them. Winning traders risk small even when they're experienced. To them, survival is the priority. They understand the power of compounding, and they know that small risks multiplied over time lead to exponential growth. This is why professional traders rarely risk more than 1% per trade. They know the math. They know the danger of ruin. They know that even the best strategy cannot survive oversized risk. The next sign of evolved risk control is respecting stop losses. Beginners treat stop losses like suggestions. They move them further away. They remove them. They hope price will come back. But winning traders never violate a stop loss. To them, a stop loss is sacred. It is the boundary that separates them from destruction. They accept when a trade is wrong quickly and without emotional resistance. This acceptance shows deep maturity because it means the trader has detached their ego from the need to be right. Risk control also manifests in selectivity. Early traders take many trades. They think frequency equals opportunity. But winning traders take fewer trades because they understand that each trade carries risk, and unnecessary trades amplify exposure to randomness. A mature trader waits for AIF setups, situations where multiple factors align and risk is justified. They skip mediocre opportunities without feeling FOMO because they know low-quality trades destroy accounts slowly but surely. Another sign of advanced risk control is adjusting position size based on market conditions. Beginners use the same size every time. Winning traders adapt. When the market is choppy, they reduce size or stop trading. When their system aligns with market conditions, they increase size strategically. Their risk responds to volatility, liquidity, and trend strength. This flexibility is one of the most important characteristics of risk-focused traders. One more sign that you're becoming a winning trader is understanding the concept of risk expectancy. Beginners care about win rate. Winning traders care about expectancy. They know that a high win rate means nothing if risk to reward is poor. They know that a low win rate can still be highly profitable if our multiples are strong. They evaluate trades through mathematical lenses rather than emotional ones. This shift in thinking creates consistency because it transforms trading from random hope into calculated probability. Another crucial element of risk control is understanding the danger of overtrading. Early traders chase every move. They feel guilty when not trading. They equate activity with progress. But winning traders understand that overtrading is one of the biggest killers of accounts. They know that every trade taken outside of their plan increases exposure to emotional errors and unnecessary risk. They become selective, patient, and calculated. They know that not trading is sometimes the best risk decision. A major sign of maturity in risk control is emotional detachment from losing streaks. Beginners panic when they lose a few trades. They increase size to recover. They sabotage themselves. But winning traders remain calm. They know losing streaks are normal. They reduce risk, not increase it. They protect capital when out of sync. They allow variance to pass without emotional interference. This calmness shows a deep understanding of probabilities. Another powerful indicator of risk evolution is avoiding catastrophic drawdowns. Early traders can lose 40% or 50% of their account because they lack discipline. Winning traders rarely exceed a 5–10% drawdown because their risk approach prevents large losses from happening. They cut losers quickly. They avoid oversized positions. They never revenge trade. They protect their account like a business protects its cash flow. A mature trader also understands the risks embedded in certain market conditions. They avoid news volatility unless their system is built for it. They avoid trading low liquidity environments. They avoid trading when spreads widen. They avoid trading during emotional states. They understand that risk is not only in position size, it is also in timing, environment, and psychology. Another advanced sign is shifting focus from making money to protecting money. Early traders focus on how much they can make. Winning traders focus on how much they can lose. They know that anyone can make money in a bull run, but only disciplined risk managers survive all market cycles. The shift from offensive trading to defensive trading is one of the most important mental evolutions at the professional level. Another sign is that winning traders take partial profits strategically. Beginners either hold everything or close everything. Winning traders scale out. They lock in gains when the market gives them opportunities. They reduce risk mid-trade. They give themselves room to survive volatility. They take pressure off the position as it moves in their favor. This adaptive profit-taking keeps their equity curve smooth and reduces emotional stress. A mature risk controller also journals risk mistakes aggressively. They study when they risked too much, moved stops, or took unnecessary trades. They treat risk errors as the most dangerous mistakes because they understand that execution mistakes can be fixed, but risk mistakes can end everything permanently. Another sign is respecting daily and weekly loss limits. Professionals stop trading once they hit their loss limit. Beginners continue trading and fall deeper into emotional chaos. This discipline prevents spirals, protects mental clarity, and ensures longevity. Winning traders also understand opportunity cost. Holding bad trades prevents capital from being available for good trades. Time stuck in a losing position is a form of hidden risk. Professionals exit quickly, freeing capital for better setups. This mindset shows deep risk awareness. Another advanced trait is recognizing when your system isn't performing well. Instead of forcing trades, winning traders reduce size or pause completely. They understand that market conditions change. Their goal is not to trade constantly, but to trade profitably. Risk control also shows up in adapting your expectations. Professionals don't expect every month to be profitable. They don't expect every setup to win. They understand that the goal is not perfection but long-term consistency. This realistic mindset protects them from overexposure during bad periods. And finally, the ultimate sign of evolved risk control is that your identity is no longer tied to one trade, one day, or even 1 month. Your confidence comes from your ability to manage risk, not from your ability to predict the market. You operate like a professional risk manager first and a trader second. Your longevity becomes your strength. Your discipline becomes your advantage. Your risk control becomes your superpower. When you reach this level of maturity, you are no longer gambling, guessing, or reacting. You are managing risk like a professional, protecting your capital like an asset, and navigating the market with the discipline of a long-term winner. This is the sign that you are stepping into the identity of a truly winning trader. Execution excellence is the hallmark of a winning trader, the invisible discipline that separates those who talk about trading from those who consistently profit over time. Many traders spend years learning strategies, indicators, and chart patterns, but fail to understand that without precise and disciplined execution, all that knowledge becomes useless. Early traders often have good ideas, but their execution is flawed. They enter late, exit too early, ignore their rules, overtrade, or manipulate their own positions based on emotion. Execution is not just about clicking buy or sell. It is the consistent application of a plan over and over in an environment that constantly tests patience, discipline, and decision-making. A winning trader begins by understanding that execution is a skill separate from analysis. You can identify the perfect setup, but if your entry is delayed, your position sizing is incorrect, or your stops are ignored, the potential edge is lost. Excellence in execution starts with preparation. The trader who executes well prepares, meticulously marking levels in advance, defining stops, determining risk, and planning multiple scenarios. They do not rely on reaction. They do not guess. They operate from a place of clarity and control. One of the first signs of execution excellence is consistency. Beginners execute inconsistently. Sometimes they follow rules perfectly. Other times they improvise or chase. Winning traders execute the same way every time, regardless of the outcome. They follow their system with discipline, knowing that consistency compounds into results. Timing is another critical aspect of execution. Entering too early exposes you to unnecessary risk, while entering too late reduces your edge. Winning traders have honed their timing to a fine point. They watch liquidity, volatility, and market structure to determine the optimal moment to act. They understand that execution is about precision, not speed. Another important factor is sizing. Early traders often use arbitrary position sizes, influenced by emotion or greed. Winning traders calculate size based on risk, market conditions, and probability. They never risk more than they can afford to lose. Execution excellence means respecting these limits without exception. Discipline also manifests in stop-loss adherence. Beginners frequently move stops or ignore them, believing the market will reverse. Winning traders treat stops as sacred boundaries. They exit when predefined conditions are met, without hesitation or regret. This is a profound mental shift, as it removes emotion from the trade entirely. Execution excellence also requires real-time adaptability. Markets are dynamic, and even perfect plans may need minor adjustments. Winning traders know when to adjust, when to take partial profits, or when to scale in or out, all while adhering to the overarching rules. They do not make arbitrary decisions but adjust based on calculated observation. Another sign is the ability to resist impulsive trades. Many beginners feel the urge to do something constantly. Winning traders sit quietly when no setups meet their criteria. They understand that missing a trade is better than entering a low probability position. This restraint is a core component of execution mastery. Journaling is a key habit supporting execution excellence. Professionals record every trade, noting not just outcomes but adherence to plan, emotional state, market conditions, and deviations. Reviewing this journal refines execution over time, turning mistakes into learning opportunities. Another crucial element is routine. Successful traders develop pre-market, in-market, and post-market routines that systematize their workflow. These routines reduce emotional decisions, increase focus, and ensure all steps for execution are followed precisely. Preparation becomes habit, and habits enforce consistency. Execution excellence also involves risk mitigation in real time. Professionals adjust stops for volatility, move size when conditions change, and exit positions when risk outweighs potential reward, all without deviating from their core principles. Emotional neutrality is critical during execution. Winning traders maintain calm during trades, regardless of price movement. Early traders react emotionally to every wick, spike, or retracement. Professionals see these as data, not threats. Calm execution prevents overtrading, revenge trading, and erratic sizing. A mature trader also respects liquidity and timing. They avoid entering during low liquidity periods or high-impact news unless specifically part of their strategy. They plan entries around areas of high probability and low risk exposure. Another sign is adaptability combined with restraint. Professionals adjust only when the logic of the market aligns with their edge, never from fear, greed, or impatience. This selective flexibility is the hallmark of advanced execution. Scaling in and out of positions strategically is another element. Beginners often enter or exit fully without thought. Winning traders may break positions into partial entries, lock in profits gradually, and reduce exposure as the trade develops, all while preserving the integrity of their initial plan. Another hallmark of execution excellence is post-trade reflection. Professionals don't just review winners, they review every trade for execution accuracy, adherence to plan, and areas of improvement. Over time, this continuous feedback loop refines skill and sharpens discipline. Professionals also avoid overcomplicating execution. They understand that simplicity reduces errors. Each step, entry, stop, target, and management, is clear, deliberate, and repeatable. Complexity introduces uncertainty, which erodes execution quality. Emotional independence plays a role in execution. Professionals trust their plan rather than second-guessing themselves based on social media, peers, or external noise. They act with conviction because they prepared meticulously. Speed is also important. Winning traders act quickly when criteria are met. They remove hesitation because hesitation often turns a high probability setup into a mediocre one. Efficiency and decisiveness are part of execution excellence. Another element is mental endurance. Trading can be long, mentally taxing, and stressful. Professionals maintain focus throughout sessions, avoiding fatigue, driven errors. They build mental stamina through practice, routine, and self-care. They know execution is sustained over time, not bursts of effort. Handling multiple setups simultaneously is another skill. Professionals know when to prioritize trades, scale attention, and manage multiple positions without losing clarity or increasing risk unintentionally. Advanced execution also involves situational awareness. Traders observe the broader market, correlating assets, news, order flow, and sentiment. This awareness informs execution decisions, ensuring entries are aligned with high-probability environments. Another subtle but critical factor is psychological resilience. Professionals accept that not every trade will succeed, but they execute each trade with precision regardless. They do not let recent outcomes cloud judgment or disrupt future execution. They treat each setup independently and follow the plan consistently. Another sign of excellence is the disciplined handling of drawdowns. Losing periods are inevitable, but professionals maintain execution quality through losses. They do not deviate from risk parameters, rules, or strategies. This prevents small setbacks from becoming catastrophic failures. Professionals also integrate pre-defined scaling and exit strategies. Every trade has multiple outcomes considered in advance. They plan partial exits, trailing stops, and risk adjustments based on market evolution. This foresight improves execution under pressure. Execution excellence also includes the ability to execute under uncertainty. Professionals enter trades when probability is in their favor, accepting that outcomes are never guaranteed. They act with precision, not hope. Another sign is the prevention of overtrading. Professionals limit trades to those that meet strict criteria. They reject impulsive opportunities that do not align with plan or risk parameters. Restraint is as important as action. Professionals also maintain a growth mindset. They treat every trade as an opportunity to refine execution, not just to make money. Feedback loops from journaling, reflection, and review enhance precision over time. Another hallmark is the integration of technology and tools without reliance. Professionals use platforms, alerts, and analysis tools to execute efficiently, but do not allow technology to dictate decisions. They control the process, not the system. Precision in execution extends to post-trade management. Professionals monitor positions without micromanaging. They adjust risk parameters when conditions change, but do so methodically, not impulsively. They maximize edge while minimizing unnecessary interference. Another key aspect is patience. Professionals wait for ideal setups. Even if it means sitting idle for long periods, they know patience protects capital and ensures high-quality execution. Professionals also maintain mental clarity under pressure. When markets move quickly, they adhere to the plan. They do not allow fear, greed, or excitement to compromise execution. Another element is adaptive scaling. Professionals enter in tranches to manage risk dynamically. They may add or reduce exposure logically based on evolving market conditions, maintaining overall discipline. Communication with self is also critical. Professionals continuously self-monitor for emotional drift, ensuring that execution remains detached and objective. This meta-awareness prevents impulsive decisions. Finally, execution excellence manifests as an almost invisible consistency. Over hundreds or thousands of trades, a professional applies their rules flawlessly, manages risk appropriately, times entries precisely, and adapts strategically. They are not perfect in predicting outcomes, but they are flawless in applying process. This repeatable, disciplined, and resilient approach is the hallmark of a winning trader. When execution becomes second nature, decisions are confident, risk is controlled, and consistency emerges naturally. Mastery and execution is what turns a good trader into a great one, transforming knowledge into results, preparation into action, and strategy into profit, solidifying the foundation for all future trading success. Pattern recognition and developing market feel is one of the most underrated and powerful skills of a winning trader, yet it is what often separates the casual participant from the professional who consistently profits. Early traders rely heavily on indicators, signals, and rigid rules, believing that following them mechanically will produce results. They miss the subtle cues in price movement, volume, liquidity, and market structure that the market constantly communicates. Developing market feel and pattern recognition is not about memorizing charts. It is about training your mind and senses to read the language of the market intuitively. A beginner may see price moving up or down, but a winning trader sees context, intention, manipulation, and probability. The first step toward this skill is observation. You begin by watching charts without the pressure of trading, noticing how price reacts to key levels, how trends start and end, how volatility expands and contracts, and how market participants behave in different scenarios. This repeated observation builds subconscious familiarity that later manifests as intuitive recognition during live trading. One sign that you are developing this skill is your ability to anticipate movements without forcing them. You begin predicting zones of support and resistance, likely reactions at liquidity points, and potential breakouts or reversals. This is not psychic ability, it is probabilistic foresight derived from pattern recognition and repeated exposure. Another indicator is noticing recurring behavior across different markets and timeframes. You start recognizing that certain setups or price actions in one instrument often behave similarly in another. The market has rhythm, and the winning trader learns to internalize it, creating mental models that guide decisions rather than relying solely on external tools. You also begin to differentiate between strong and weak patterns. Not every breakout, reversal, or candlestick formation carries the same probability. Winning traders weigh setups, integrating multiple factors such as volume, context, liquidity, trend strength, and timing. They understand that probability is layered, and they act only when enough layers align in their favor. This advanced recognition allows them to avoid low-quality trades that beginners often chase. Another key aspect of pattern recognition is reading market psychology. Price is a reflection of human behavior: fear, greed, manipulation, and herd mentality. Professionals recognize where institutions and smart money are likely acting, where liquidity is being absorbed, and where traps are being set. They understand the intentions behind moves, not just the moves themselves. A clear sign of developing market feel is the ability to sense accumulation and distribution phases before they become obvious. Early traders enter trends late because they react to visible price action. Winning traders sense where institutions are building or unloading positions, allowing them to enter ahead of moves rather than chasing them. They understand that following the herd rarely leads to edge. Another element is recognizing exhaustion and overextension. Price rarely moves in straight lines. Professionals identify when a trend is overextended or when a reversal is likely, not through random guesswork but through pattern, volume, and contextual cues. This ability allows them to avoid entering at the worst times and to take profits at optimal points. Market feel also includes subtle timing awareness. You begin recognizing the best moments to enter and exit based on the ebb and flow of price rather than just static levels. You notice that certain times of day, market sessions, or volatility bursts carry higher probability setups. Professionals exploit these patterns consistently. Developing pattern recognition also requires emotional detachment. You must observe without forcing bias, without hoping for a particular outcome, and without letting past trades influence your read. This objectivity allows patterns to communicate truth rather than filtered perception. Another key sign is the ability to synthesize multiple factors simultaneously. You no longer see a single indicator or candlestick, you see trend, momentum, liquidity, volume, market phase, institutional behavior, and correlation. This multidimensional recognition allows professionals to act decisively and accurately. Another important factor is recognizing manipulation and traps. Beginner traders often get caught in false breakouts, stop hunts, and liquidity sweeps because they react only to surface-level price action. Winning traders anticipate these events because they have internalized market behavior. They understand how larger players influence price to create opportunities for themselves. Market feel is strengthened by journaling and reflection. Professionals constantly review charts, noting reactions, setups, failures, and successes. Over time, this creates a mental database that allows rapid pattern recognition in real time. Another indicator of developing this skill is the ability to simplify charts. Professionals strip away clutter, focusing only on key levels, volume, structure, and price movement. Simplicity enhances clarity, allowing patterns to emerge naturally and reducing noise-induced errors. Market feel also involves anticipation rather than reaction. You start predicting where liquidity will be swept, where momentum will shift, and where the market is likely to trap the impatient. You enter before moves occur, rather than after, creating a natural edge. Another sign is improved risk-reward efficiency. Recognizing high probability patterns allows professionals to take trades with superior risk-reward ratios. They enter precisely, manage stops strategically, and exit at optimal points, maximizing expected value. Pattern recognition is also about adaptability. The market is not static. Patterns evolve. Professionals detect shifts in behavior, structural changes, and unusual volatility, adjusting their approach without abandoning their framework. Another element is the development of trading intuition, which is actually experience-based pattern recognition manifesting subconsciously. You make rapid decisions based on learned behavior, mental models, and probability rather than emotion or guesswork. This intuitive execution is honed over thousands of observations and trades. Professionals also develop spatial awareness of price levels. They recognize zones of high liquidity, clusters of orders, and key structural points that beginners often ignore. This allows them to enter with precision and avoid traps. Another sign is the ability to recognize market phases in real time: accumulation, distribution, trending, retracement, and exhaustion. Each phase carries different probabilities for setups. Professionals align their strategies with current phase rather than forcing setups into unfavorable conditions. Another critical indicator is response to volatility. Professionals recognize when volatility is favorable and when it increases risk. They enter high probability setups only when conditions are optimal. This awareness protects capital and improves execution quality. Professionals also recognize patterns in multiple timeframes simultaneously. They understand how smaller timeframe moves interact with larger timeframe trends. This multi-layered recognition allows superior entry points and risk management. Pattern recognition also extends to contextual probability. Professionals combine technical, structural, and behavioral cues to calculate probability before entering. They don't trade in isolation but see the market as an interconnected system. Another sign is learning from failed patterns. Professionals dissect every missed or failed setup to understand why it did not perform, refining their recognition and timing. They learn faster than beginners because they study context rather than just outcome. Professionals also develop pattern scalability. They recognize that similar structures may occur across different instruments and timeframes, allowing knowledge to transfer and edge to compound. Another hallmark is subtlety in observation. Professionals notice small shifts in momentum, volume anomalies, liquidity imbalances, and microstructure signals that beginners miss. These small cues often precede major moves. Another element is patience with pattern maturation. Professionals wait for patterns to fully develop before executing. Rather than forcing entries too early, they understand that premature execution increases risk. Another sign is anticipation of reversals and continuation moves. Professionals can predict where a trend may exhaust or where a breakout will succeed, allowing superior positioning. Another key indicator is emotional neutrality during pattern observation. Professionals observe patterns without bias, allowing accurate interpretation rather than wishful thinking. Another sign is precision in execution following pattern recognition. Recognizing a pattern is only valuable if entry, stop, and target are precise and disciplined. Professionals maintain this integration consistently. Another element is pattern adaptation. Markets evolve, patterns shift. Professionals update their recognition models continuously, maintaining an edge despite changing conditions. Another subtle sign is recognition of subtle manipulation. Professionals sense when price is being moved to trigger stops or create false signals, and they adjust their execution accordingly. Professionals also integrate market feel into risk management. Recognizing high probability patterns allows them to size positions appropriately, place stops effectively, and manage risk dynamically. Another sign is the ability to synthesize visual, quantitative, and behavioral cues simultaneously. Professionals process multiple layers of information effortlessly, making decisions with high confidence. Finally, developing pattern recognition and market feel is the culmination of observation, discipline, experience, and analysis. It allows traders to operate with intuition grounded in probability, anticipate movements, execute with precision, and maintain consistency. This skill transforms trading from mechanical indicator following into adaptive, informed, and high-probability decision-making, marking the unmistakable signature of a winning trader. Discipline in trading is the invisible force that dictates long-term success. Yet it is one of the most difficult skills to master because it requires control over both actions and emotions simultaneously. Early traders often struggle because they focus on strategy, indicators, and setups without developing the mental framework to consistently follow rules. Discipline is what bridges the gap between knowledge and consistent execution. A disciplined trader follows their plan with unwavering consistency, regardless of external noise, short-term results, or emotional impulses. They do not chase trades, they do not overtrade, and they do not let fear or greed influence decisions. Discipline is not about rigidity. It is about structure and predictability. One of the clearest signs of a disciplined trader is adherence to risk parameters. No matter how confident they feel, they never exceed predetermined risk limits, always respect stop losses, and adjust position size based on market conditions. This consistency protects capital and creates a foundation for compounding gains over time. Another key indicator is patience. Disciplined traders wait for high probability setups instead of forcing trades that do not meet criteria. They understand that missing trades is part of the game and that taking low-quality setups diminishes edge. Patience also shows in trade management, allowing positions to develop according to plan rather than exiting early out of fear or emotion. Emotional control is closely tied to discipline. A disciplined trader maintains composure in both winning and losing trades, staying neutral and objective. They do not celebrate prematurely or panic during drawdowns. This emotional steadiness prevents impulsive decisions, revenge trading, and size violations. Journaling and self-reflection are other hallmarks of discipline. Professionals review every trade, not to celebrate wins but to measure adherence to plan, execution quality, and emotional responses. This continuous feedback loop strengthens discipline over time. Another sign is routine and structure. Disciplined traders follow pre-market preparation, in-market monitoring, and post-market analysis rituals that standardize behavior and reduce the chance of errors. Routine enforces consistency, making disciplined execution almost automatic. They also demonstrate restraint in adverse conditions. If the market is choppy, volatility is abnormal, or setups are weak, they step aside rather than force action. This restraint is a direct expression of discipline, showing that they respect risk and the market more than ego or desire. A disciplined trader is also able to separate results from process. They measure success by execution quality, adherence to rules, and probability alignment rather than by individual trade outcomes. This detachment strengthens mental resilience and prevents emotional erosion. Finally, discipline manifests as adaptability within structure. Professionals adjust position size, stops, or trade management according to market context, but always within the framework of their rules. This balance between flexibility and consistency is the hallmark of mastery. When discipline is fully internalized, it allows the trader to act decisively, protect capital, follow the plan flawlessly, and operate with confidence, creating a foundation upon which all other skills, risk management, pattern recognition, emotional control, and execution, can consistently produce winning results. Discipline is the silent engine that powers all other trader attributes, and its presence is the unmistakable sign of a trader who is truly winning. The final hallmark of a winning trader is self-awareness and continuous improvement. The silent forces that ensure growth never stops and that every experience becomes a lesson for the future. Early traders often repeat mistakes because they lack the perspective to analyze their decisions objectively. They blame the market, external conditions, or luck instead of taking responsibility for their actions. A winning trader understands that mastery is a journey, not a destination, and that each trade, whether profitable or losing, is data to refine skill and strategy. Self-awareness begins with honest assessment. Professionals review their emotions, decisions, and execution to identify patterns of behavior that help or hinder performance. They ask questions like, did I follow my plan? Did I manage risk appropriately? Did my emotions influence my decisions? Did I enter and exit at optimal points? This kind of reflection develops clarity and insight, allowing them to correct course and enhance consistency. Another sign of self-awareness is acknowledging psychological triggers. Winning traders know which scenarios make them impatient, fearful, greedy, or reactive. They implement strategies to manage these triggers, such as taking breaks, scaling position sizes, or focusing on rules rather than outcomes. This prevents emotional hijacking and strengthens decision-making under pressure. Continuous improvement is another hallmark. Professionals are never satisfied with the status quo. They study market behavior, refine strategies, explore new techniques, and learn from other traders, but they filter external information critically, only integrating what aligns with their principles. They treat trading as a craft that requires deliberate practice, not as a game of chance. Journaling is central to this process. Every trade is recorded with context, execution notes, emotional state, mistakes, and lessons. Reviewing the journal regularly turns individual experiences into a comprehensive feedback system, accelerating learning and fostering long-term growth. Another sign is humility. Winning traders accept that they do not know everything, that markets are unpredictable, and that failure is part of the process. This humility allows them to stay open to learning, adapt to changing conditions, and avoid overconfidence that can lead to catastrophic mistakes. They balance confidence with caution, conviction with flexibility, and action with patience. Professionals also recognize the importance of mental and physical well-being. They understand that fatigue, stress, and distractions erode decision-making and execution quality. They incorporate routines, rest, and self-care into their trading lifestyle to maintain clarity, focus, and resilience over the long term. Adaptability is closely tied to self-awareness. Winning traders notice shifts in market conditions, personal performance, or emotional state and adjust accordingly. They may reduce trade frequency, alter position size, or step away temporarily to recalibrate. This responsiveness ensures consistency even when conditions change. Another sign is long-term perspective. Professionals do not obsess over individual trades, sessions, or even months. They focus on cumulative edge, compounding growth, and the sustainability of their approach. This perspective prevents emotional overreaction and supports disciplined, strategic behavior. Finally, the combination of self-awareness and continuous improvement produces confidence grounded in competence rather than ego. Winning traders trust their preparation, process, and principles because they have tested, refined, and internalized them. They do not rely on luck or prediction, they rely on deliberate skill. This mindset closes the loop of trading mastery. With emotional control, risk management, execution excellence, pattern recognition, discipline, and continuous self-improvement all working in harmony, a trader is no longer reactive but proactive, no longer guessing but calculating, and no longer hoping but executing with precision. Self-awareness and continuous improvement ensure that growth is perpetual, mistakes are learning opportunities, and mastery is a living process. This final attribute cements a trader's identity as a winner, capable of navigating markets with clarity, resilience, and enduring success.